Hello everyone and welcome to another real estate video. This is Javier Vidana, the real estate YouTube guy in Phoenix, Arizona, helping you accomplish your home goals. First and foremost, yes, I shaved my head. Didn't want to go to the barber because I'm taking this whole thing seriously. And you know what? Every time I build a video game character, I always go shaved head, beard. So I'm gonna live my fantasies out and try to do it. If I end up looking ridiculous, I'll grow it back out. All right, guys, so in today's video, I want to talk about something that I'm already starting to notice with a lot of lenders throughout the country, but also kind of like predict what's going to happen to a lot of the programs that a lot of first-time home buyers use, like FHA, conventional, the down payment assistance programs specifically, and just kind of talk about what's going on and what I predict is going to happen with the guidelines that they use to qualify for a house. Too long didn't read. I'm going to talk about how it's going to start getting a lot harder for you to buy a house in the next few months, maybe even permanently after this point. Now, some of this is actually happening now, but a lot of this is speculation, and a lot of my speculation videos get a lot of people that come in from the channel and just to kind of crap and don't even watch it the whole way. So you know what, it is what it is. It comes with the YouTube. So, but anyways, let's get straight to it. So first and foremost, guys, FHA, as you remember, historically has always been the following case. You would always need at least a 600 credit score, and the way it was judged was it didn't matter if you were at 600 or 800, you were going to get the same terms as most people with FHA. This means a nice cheap interest rate or low interest rate like 3s or 4s. Down payment was always about 3.5%. It didn't really make sense for you to come up with anything out of pocket after that fact, unless you were trying to pay off your mortgage insurance, have a job for at least 2 years, and usually just required one job verification in the beginning of the process, with maybe a phone call towards the end. And of course, that debt to income ratio being 45-ish%. And I made tons of videos about how to calculate this. So if you haven't watched them, feel free to watch them. So what's been happening this past month is specifically with mortgages and mortgage providers. These companies make money by servicing loans and producing loans. So when I say servicing loans, I mean when the house has been closed and, for 30 years, you're paying your payment to it. That's why a lot of times it gets sold to different companies because they're servicing the loan. And of course, loan producing, meaning they created the loan. Now, obviously I don't work for a mortgage company, so I don't have the exact numbers, but I'm going to give a pretty educated guess that a lot of these companies are in a panic right now. My guess is at least half, if not more, if not less, people of the mortgages they service are being affected in some way. Either some of them are refinancing with another company, or just refinancing with the same company and getting a better interest rate, which is not good for their investors because they're making less money, or a lot of them are losing their jobs and going into forbearance. Now, as you know, forbearance isn't going to permanently hold these 3 months of payments or whatever it is. It's just going to say, hey, we're going to give you a break, and then when the 3 months are over, they're going to be like, all right, pay up, sucker. So it's not really helping. It's just kind of delaying what's hoped to happen. I guess their hope is by delaying it 3 months that people will be able to find another job and find a way to pay it. I don't know what's gonna happen there. Of course, they're starting to lose their crap. Their investors themselves. As a matter of fact, I heard inside scoop here, this is just speculative, that Quicken Loans, the #1 loan servicing company in the country, and probably the face of loan origination when it comes to mortgages, are actually asking for a bailout from the government because they're concerned that they will go bankrupt. So because these loan servicing companies or these loan origination companies or whatever you call them are in a panic, things are going to change. They're going to get a lot stricter with the loans they allow. Now, we lived in the golden age. And now, in hindsight, I can see the last 7 to 8 years was pretty good. It was a recovering economy. Home values weren't just increasing at a 3 to 5% rate. They were increasing pretty good. So people that were living in their houses were able to sell it a few years later and make a good chunk of money. Lord knows a lot of people, especially my family, we benefited from that. We're able to grow. The programs themselves, at first, the down payment assistance programs were pretty easy, but then they got a little stricter. But it was very clear. You either saved up a down payment, got a pretty good interest rate, or you went for a down payment assistance program with a higher interest rate. Things were pretty straightforward and simple. And in hindsight, I'm gonna miss those days. So with things kind of being in a panic right now, certain lenders are concerned with the ability that these buyers will have to keep paying their payment. So they're gonna start putting like overlying guidelines for their loan programs. I'm getting already words that FHA specifically, they're not just 600 credit score no more. We're looking at 640 FICO scores, 660, 680. This is terrible news because if you're already in the high 600s, I mean, you might as well explore different options of the conventional, right? What would be the point of going with FHA at that point? It really wouldn't make any sense. So, and if you're looking for specific bond programs, these companies are just completely saying no to them now. They're saying, you know what? They're too risky. These buyers have no skin in the game. We're not going to be funding to them anymore. My honest prediction about bond programs or down payment assistance program, guys, is they're going to probably be gone for the next year or two, at least a regulated guideline. I don't know if there's other companies out there or you know, maybe unregulated programs out there that are going to be popping up. Feel free to share them if you have them, but my opinion of it is these lenders are not going to be taking these risks anymore, and they're going to be specifically focusing on higher, what they consider quality buyers. Now, when they say quality, I'm going to talk shortly about what guidelines are going to change, but that's what I think is going to happen. So in my reading online and talking with different people up there and seeing the changes that are happening with other states and programs now, here's my predictions of what the new guidelines for FHA is. Now, keep in mind, these are my predictions, and this is not necessarily true. Your lending company might have similar ones, may not have similar ones, but I think it's only a matter of time before the government comes out and says, hey, these are the new guidelines. And if that does happen, please look at the first comment. I'm going to pin it below. This video is only speculation, okay? Make sure you're getting that now. So I believe that the minimum FICO score for all buyers when it comes to borrowers, when it comes to FHA, they're not going to be 600 anymore. I think they're going to probably rise for the mid 600s. Now, on the low side, I'll say 640. On the high side, I'll say about 680. The reason why I'm focusing on those numbers is because for down payment assistance buyers, which were already considered higher risk, the minimum was at least 640 in some cases, and the ones that got the most benefit with better rates were in the 680, 660 category. So I believe that's going to be the new guideline because they've already kind of practiced with these kind of borrowers. And if the down payment bond programs do come out again, I'm going to assume that they're going to be probably in the 700s for the FICO score. Now, the only way I see this not happening is if we do go into a complete market crash of unforeseeable disaster, and the market needs to recover, and then they start releasing these programs out again to help people recover and get into a house again. It used to be a rule that if you didn't have your down payment, you could always just get a gift fund from a friend or family member. And the good thing about these gift funds is they didn't have to be traced a lot of times. They could just be a lot of times it could just be like a bank transfer to your account, and they wouldn't need to verify with that person's bank account where that money came from, unless they were like it was a cash deposit or some other way than they did. So I think that's going to change. They're going to get more stricter where the money's coming from. They want to make sure that you're not just buying a house with borrowed funds. So I think it's going to probably mean that if there is some kind of someone letting you borrow the funds of the property, they either have to get verified with assets of, I would assume, at least a few months to 6 months, maybe even a year. On that same topic, I also do believe that people who are depending on their 401k, there's going to be more restrictions on that. I don't know exactly what's going to happen. They're probably going to be only allowed to use a percentage of the down payment, not necessarily the whole entire amount. So I'm expecting that to change as well. I think with these lenders kind of being spooked and only allowing high qualified buyers, I think they're kind of just put, if there's a gas pedal on letting loans in, they're kind of just going to slow it down. They're going to put the stop sign. And I think one way of them doing that is they're going to increase the interest rates. Now, normally I wouldn't like to say a number here because it opens me up to criticism from you guys saying you're wrong, but I'm going to say it. My prediction is FHA, specifically people who are looking to buy a house for the first time, the normal program that was being used, it's probably going to go above the 5. I'm hoping it stays it's in the 3s now. It's probably going to go for the 4s for sure in the next few months, but ultimately I think it's end up being in the 5s. What's going to happen with conventional interest rates? Well, they only are really low for people that are really qualified, like people who had like 800 credit scores and like 20% down and like amazing everything else. They were getting 3s, they were getting maybe low 4s, and then people who were like, had the down payment, but their credit was like in the 700s, they were getting 4s, 5s around there. So I think a low rate interest rate for conventional is going to start becoming maybe about 4s. I don't think threes. I think threes is still too low. And I think the standard for conventional interest rates might go above where FHA is. I think it might be in the 6s or 7s. Only because conventional has always historically been a little higher than FHA. If you like get a 680 buyer with a 680 FICO score, you put them against FHA and conventional, FHA will always have the lower interest rate. Unless the buyer didn't have a 680, had a much higher interest rate, then and many times then they would get a better rate with the conventional. So that's what I think is going to happen, guys. I'm foreseeing a future where only the higher qualified buyers are able to buy. And I'm seeing this being done to prevent people from buying because these lenders are starting to lose money for their investors. And this is their way of kind of halting everything. My prediction, prices are going to start slowly going lower. If this continues to keep going longer than it needs to, they're going to continue to go lower and interest rates are going to go higher. And the qualification of the loans is going to be more stricter. So only higher qualified buyers are going to buy. So those people who were like, ooh, I can't wait for the prices to start tanking. Well, I hope you took care of your credit. Everyone else out there, priority should be try to maintain your credit score as best as you can. Try to talk with your banks, try to talk with your credit cards, do whatever you need to so you don't get any 30-day, 60-day lates. If you have to make minimums, make minimums. Do whatever you can to not let your credit sink during this time. If your credit sinks and you're looking to buy a house in the future, you're going to put yourself in a bad spot. Do what you can to take care of your credit during this time. Once the storm passes, if you come out of it with better credit, then you're putting yourself in a good spot. Now that's all the time we have for today's video, guys. Thank you so much. Once again, I want to say this is just my predictions and my opinions. I hope that I am wrong. And if I end up being wrong, please let me know how wrong I was in the comments below. Let me know what you guys think. I appreciate your time. If you're looking to buy a home soon or sell a home soon in the Phoenix, Arizona area, that hasn't changed. My contact information is below. Reach out to me, get to know me, call me, text me, do what you need to do. Things are a little crazy right now, so it might take me a little longer. So if you want to get a hold of me, just call me, right? All right, guys, thank you so much for your time. I appreciate it. Have a wonderful day.